All right. This episode's not gonna be funny. This is gonna be like a heart to heart. I'm not gonna put the memes and all that stuff in there in this episode. This is literally a heart to heart, me to y'all. If you are a trader, this is not the episode for you. If you are a long-term investor and you've been investing for 5, 10, 15 years or so, this episode is also not for you. Keep doing your thing. But make sure you give me a thumbs up and subscribe if you haven't done so yet. This episode is specifically for people who started to invest within the last 2 to 3 years around the pandemic time frame, because I think it's time we have a discussion so you have a better idea how to move forward, hopefully. So stay tuned. What's up, everyone? My name is Mark. You're watching Trading with a Dummy. Usually I try to make all my episodes funny, but this is not happening today. Today I just want to get straight into it. The S&P 500 obviously on Friday has dipped below 3,600, so it blew past June's low. Now, I know you're seeing a lot of videos, this fear mongering, talking about, the market crash is here, the world's ending, you're gonna lose all your money, blah, blah, blah. That's not what this episode is gonna be about, but I am gonna have a heart to heart because we need to have this discussion. Obviously, when people are fearful, you should be greedy, and when people are greedy, you should be fearful. I understand that. That's a saying. Everyone talks about it, blah, blah, blah. You also see a lot of gurus telling you this is the time to buy, everything's discounted, and all other stuff. Me and Mo talked about this on Money Market Truths, our last episode. Check it out if you haven't done so yet. Also subscribe to that channel. I really appreciate it. We had a special guest named Zay, the wealth strategist. So check that out. But yeah, today we made new lows, notching nearly 25%. We are, yes, officially in a bear market territory where we reached that once we passed the 20% mark. But what's even more interesting is that in this past 9 months, we literally suffered the third worst performance since 1931. And I'm going to show you a chart here real quick. This is from Bloomberg. It kind of gives you a representation of how our drop has compared to all the previous bear market drops. But like I said, it's been the third worst in a 9-month period. The reason why I'm saying 9-month period is because typically prior to bear markets, the average sell-off is anywhere from like 35 to 39% on average, right? However, that is usually within a 20-month span where we have reached this literally in 9 months. So we still have potentially 19% to go, but it's just crazy like how fast we sold off in a 9-month period. What I also want to show you here real quick is the SPY chart that I created on TradingView. So let's jump over to that real quick. As you can see, this is the SPY chart. I have some key levels that I pointed out here, and the reason why I want to point it out is because there could potentially be a reversal, a temporary rally relief come Monday. As you can see right here, I have the SPY up with the Fibonacci retracement going from the bottom of the pandemic all the way to the all-time high, and we're currently literally notching the 50% area, which is a key level as well, which happens to also be the demand zone, which is at $352.62 to $361.14 on a weekly demand, which also happens to be near the 200-day EMA, which was $367.50. So what you're seeing right here is just a true representation of where we're at, because this is a crucial part. We have not sold off yet on the RSI level, but we're getting pretty damn close. We're currently near, 34 on the RSI. So you could imagine that there will likely be a relief rally coming sometime soon, but I do not think this is the bottom. I mean, what I'm trying to explain here is when it came to majority of these indicators and these studies and historical data that everyone was talking about, the market has completely blew through all of them. The 20, the 50, the 200-day EMA, they all failed, including this one, the 50% indicator, which is basically a tool. Also got that from Bloomberg, that was basically supposed to have this like perfect record. Everything always bounces off of that, and obviously that did not happen this time. This 50% indicator, which usually doesn't failed. So my point being is that we're in a completely different environment. For the past 13 years, we were in this environment with literally almost no interest rates, or just really severely low interest rate. So at that point, people were buying. We were in a bull run for the past 13 years, realistically. Yes, once the pandemic happened, we dropped significantly, and then we just ran like crazy once again, which was Looking back, very unrealistic, and we should have known better. Because again, I started investing around the pandemic time frame, and we all thought, let's just be real, we all thought that we were great investors, great traders. Anything we got into ran. When we came to Kathy Wood's funds, the ARKK, the ARKF, all those, every single thing ran. Tesla ran, Nvidia ran, Apple ran, everything ran. Growth stocks ran. So it made a lot of YouTubers, it made a lot of us get extremely cocky, confident, and we believed that we were great investors. Unfortunately, like I said earlier, when everyone's greedy, you should be fearful. When everyone's fearful, you should be greedy. At that moment, after that pandemic, when everything was running up, we should have been fearful. Real financial advisors were fearful. Hence why if you had a good financial advisor, not one of the ones from like the brokerage banks and stuff, the ones that just call you up into more like an actual financial advisor, one like I got that works with Jazz Wealth, these people literally started selling off shares and stocks and going cash before the November drop. Why? Because again, they were becoming fearful because just couldn't sustain the trend that we were going. And unfortunately, a lot of us, like myself, did not take profit like we should, because depending if, again, this is not trading, this is investing mindset. We all started investing in a massive bull run. So our mentality was, remember, hold 5 to 10 years, hold 5 to 10 years. And here we are going on the third year, and pretty much everything that you probably bought within that time frame, you are either getting close to being negative or break even if it was like Microsoft and Apple, but majority everything else, you are probably massively down, especially if you invest it into growth stocks. You are down. What I'm really trying to get at in this video is that instead of going after these individual stocks, which yes, could potentially give you a better return down the line, start creating a portfolio that's majority index funds that maybe tracks the S&P 500 and maybe NASDAQ. For example, these are literally the top funds that you could invest into that tracks the S&P 500. SPY, obviously, that's also every trader's favorite, SPY. Then you got IVV, which also tracks the S&P 500. Then you got VOO, it's the Vanguard, also tracks the 500. Then you also got SPLG, which also, once again, tracks the 500. Those ETFs literally are affordable at all price range. VO is probably the most expensive one. SPLG is probably the cheapest. SPLG is literally, I think, around $42 right now. You can invest into the S&P 500 with little money to a lot of money, depending which fund you want to invest into. It's not a bad idea to start putting majority of your money into these funds while we're in the downtrend and while we end up start reversing back to the upside. This I would consider dollar cost averaging and buying the dip, if you know the levels. If you don't, just dollar cost average every single month, take a little bit of money and then put it into these S&P 500 indexes. I will tell you this, if you wait for the third week of every single month, typically historically what I've seen is that there's a pullback. It's OPEX week. So usually you have a pullback, and that's when you can get probably the lowest levels of the month. That being said, also, we're now in October. October is historically a bad month as well. So be careful. Know that the market is most likely going to come down unless we get that quick relief rally, which we have failed multiple times in these past 3 weeks, which honestly is quite shocking. I didn't expect it to drop as drastically as it has, but it seems like the bulls cannot hold the market up, and Apple finally collapsed below 150. It's now close to 140. That's nearly a $10 drop in a matter of a week. So understand it's going to still be rough. Another thing I want to talk about it is for all the people who love dividend stocks, right? We always talk about dividends and how dividends can bring you passive income and etc. But obviously you need lots of money that you need to invest into dividend stocks. But instead of going and trying to find which stock is a good dividend stock, which one isn't, Nike, Microsoft, AT&T. Actually, I don't even know if Nike has a dividend or not. Let me go look that up real quick. Yeah, Nike does have a dividend. There's no reason for you to have to do all that work which is honestly technically unnecessary. And I tell you why, because there are other index funds, once again, which can help you get exposure to dividend stocks without taking those massive risks of trying to buy 10, 15, 20 different dividend stocks and keep investing into those. And I'm going to show you two indexes which I actually like, and one of mine I'm invested in. I'm not going to tell you which one because I have a Roth, and that to me is very private, so I have only index funds in those Roths. I'm not going to tell you which ones, but if you pay attention to my channel, you'll pretty much get an idea. But I am invested into one of these, and I'm going to show you the two that I recommend, which is VIG and VYM. And this is just a comparison to show you how they performed throughout the past 2 weeks, 1 month, 3-month period, the dividend that they pay out, the date, the 200-day volatility percentage, like all that stuff. It gives you a comparison. But not also what's important here is that the holdings, it shows you the holdings in each one of these. VYM has 444 holdings versus VIG, which has 291 holdings. They're not too expensive. I believe VIG is currently at like 130 something, and VYM is below 90 bucks. What you also see here is that the VIG is basically a dividend appreciation ETF, meaning that has like the stocks in it that appreciate throughout time, versus VYM, which is a high dividend yield index. So they kind of go more for the ones that are a little bit more of riskier, who may have a little bit more ups and downs compared to VIG. Both of them, I think, are relatively good. Do your own research. Once again, I'm not a financial advisor, but I do like both of them. Their expense ratio is not bad. It's literally 0.06%. So if you're into dividend stocks, instead of just trying to find and buy a bunch of individual ones, just invest into that. That's just my personal opinion. Let me transition back over to myself real quick. Another thing that you should possibly think of right now, because the market is so volatile, and if you don't want to invest into stocks and indexes and you just kind of want to have your money sitting somewhere where you're kind of guaranteed to get a decent return, take a look at the I bonds, the I series bonds. You have until the end of October to actually invest into the series I bonds. You can go to Treasury Direct, and this is how you invest into it, and it kind of gives you a breakdown exactly what you get in a Series I savings bond. Like I said, you get 9.62% is what you will be eligible for. The only downfall is that you can only invest $10,000, but that's not bad. I'm just gonna be real. $10,000 with nearly close to a 10% return within a 6-month period is not bad. The thing is here though, you kind of want to keep it in there for a long period of time, at least a minimum of 5 years. And the reason why is because it says it right here, how long must I keep this bond? I bonds earn interest for 30 years unless you cash them out first. You can cash them after 1 year period. Yep, so after a year you can end up cashing it out. But if you cash them before the 5-year mark, you lose the previous 3 months of interest. So for example, if you cash an I bond after 18 months, you only get the first 15 months of interest in return. So this is not a bad idea as well. Again, this ends come the end of October, so this is something that you can look into as well. Obviously, some brokerages you might actually be able to buy that through your brokerages, but this is literally the easiest way, is go to this old ass treasurydirect.gov website, set everything up, and then you could invest $10,000 in it, and and you guaranteed to get at least 9.62% back after a year, which is that's amazing. You're literally beating the S&P 500 most likely this year. And looking forward, I mean, there's a lot of news. I've been reading a lot of articles on Bloomberg, and they're saying that some of these analysts and hedge fund managers and people who work at these banks, they believe that we're not going to actually see a turnaround until mid to late 2023. So this whole idea that the Q4 is going to change the game when it comes to the market, I don't think so. There's a lot of things that we got to understand. Like I said earlier, a lot of these investors who are talking to you about, oh, fourth quarter is coming up, or we're going to hit at this level and we're going to bounce, we reached the bottom, blah, blah, blah. A lot of these people have been investing in the past 13 years, but we've never seen an environment that we're in now. That's the thing. Our environment is drastically different than it was for the past 13 years. Not only did we deal with a pandemic, but now we also have to deal with quantitative tightening. We also going to deal with inflation. We're also dealing with interest rate hikes. We're most likely going to deal with a housing crash. We're inserting ourselves into Ukraine. Things are just getting worse over there right now. And we're inserting ourselves into the whole Taiwan issue. We have a relatively weak administration. Tech companies are firing people left and right. They're cutting back on certain things, production. We have supply chain issues. There's so much that's going on that it's really hard to go off of historical data because we have never really been in a situation that we're in today. Literally, this is unprecedented. This has never been like it is now. So it's hard to take data from the past and say like, well, historically 5 years ago, or historically in the housing crash, or historically in a dot-com bubble, those are all completely different than what's going on right now. We are having issues, not what's happening in Europe right now. And look at what's happening with the UK. They're literally starting this whole quantitative easing and just going to start printing money left and right because their currency is literally collapsing. Europe's currency is literally collapsing right now, and the dollar for right now is actually somewhat strong. So it's just insane what's happening in the overall environment, because we have to sometimes think macro and micro, okay? Because that is important when it comes to investing. It's not just looking at a company and saying, oh, this company looks good, or this company is undervalued. Yeah, Meta's currently undervalued, sure, but look at the environment we're in right now. Or another one I keep seeing a lot of people talk about, Warner Brothers. I like Warner Bros. I love HBO Max. I'm looking forward to what they're doing. They're making a lot of cutbacks and all this other stuff. But people are literally saying this is the most undervalued company right now. It's time to buy. I think it's probably going to go to $9, to be honest. But Warner Brothers, it's a growth stock. It's literally basically a growth stock. And is our environment friendly to growth stocks? Absolutely not. That's why you see all these shit stocks. That's why I call some of them, like SoFi, Palantir, Lemonade, Tattoo Chef, which really is a shit stock, and all these other companies, all these growth stocks that everyone thought was going to boom, that actually did boom during the pandemic, because again, 0% interest rate. I mean, we were in quantitative easing. It was easy to get loans. Now it's not. Interest rate is higher. So these companies have to make cutbacks, and investors want to take profit and move their money into safer areas, because right now this is not the environment for growth stocks. You got to think a little bit bigger and look at the macro and the micro environment and see how that could potentially affect these companies and these stocks that you're invested in. And the safest route, in my opinion, once again, is to start nibbling in the S&P 500, or if you like NASDAQ and you like tech, look at QQQ. Also a good potential ETF that you could start nibbling at. And then when you see a clear reversal, when you see the economy change, maybe that's the time to start buying some individual stocks, because then you'll see an actual clear reversal versus just constantly buying this downtrend, which a lot of us have been doing for the past fucking year. So again, my name is Mark. I just want to have a heart-to-heart with y'all. Hopefully you enjoyed this episode. I know I'm sometimes long-winded, but I literally just want to get this off my chest because I feel y'all's pain. I've seen the conversations in some of these Discord groups. It sucks. But when everyone is fearful, be greedy. But don't be greedy in a reckless way when the market is literally in a downtrend. Not the buying the dip time yet. Peace out.